Bitcoin is currently trading at $28,723, and joining us now to discuss the crypto markets is Arca Chief Investment Officer Jeff Dorman. Welcome, Jeff.
Thanks for having me.
So Bitcoin has been leading the way for the crypto market in 2023. Is that somewhat unexpected, Jeff?
Certainly unexpected to me. I've been doing this now professionally for well over 5 years and, recreationally for much longer than that. And Bitcoin, over the last 3+ years has really been pretty boring relative to the advancements of stablecoins and NFTs and DeFi and everything built on Ethereum and other layer ones. The last 4 months, it's been entirely a Bitcoin show, and for real strong reasons, right? I mean, combined with, what we're seeing with the debt ceiling and now USA 5-year and 1-year CDS blowing out, combined with the regional banking failures, not to mention just the waking up of the world to what owning a bearer asset really means, and how, 2 months ago, people felt pretty safe in a bank account. Now, people don't feel safe in a bank account. I think probably only a money market account and a brokerage account is probably the only thing really safer at this point than a bearer asset like Bitcoin. So it's great to see. Certainly like to have real reasons for price increases and not just empty narratives.
Right, Jeff, you talk about the digital bearer asset narrative and or investment thesis for Bitcoin. So I kind of want to ask a little bit about this illiquidity that we're seeing. So I'm not sure if you saw it, but there was a $56,000 wick on Bitfinex perps today. Now, liquidity is really thin there, but I think liquidity is pretty thin everywhere. Is this something that we should be concerned about?
Well, I mean, look, a lot of the people in the digital asset market come from either a FX background or from a technology stock background or from a derivatives background, right? I come from a distressed bank and bond background. This is the same sort of shenanigans you see in the corporate bond market every day for the last 30+ years, right? I mean, you have 50 different broker dealers who are putting out prices on bonds, and maybe 48 of them are 82 on a bond, and all of a sudden you give an order to some a bucket shop and say, hey, go make it 92 just to see what happens. And all of a sudden you get hit at 90, and every other broker dealer is like, whoa, why is it up at 90? What news did I miss? And they take their prices up, and then you slam those, right? So, there's a fine line between intentional market manipulation versus price discovery. But this is not unique to digital assets. It just gets a lot more coverage.
Yeah. So in talking about market manipulation, and I'm not implying that the Fed is manipulating markets, but are you expecting fireworks during tomorrow's FOMC meeting?
Not really. I mean, I think, look, you go back, again, 3 years ago, 5 years ago, 7 years ago, 90% of the people in digital assets didn't even know when the FOMC met. This is really a story of the last 18 months. But when you go back to, October, November of 2021, when the rate hiking started, and then the acceleration in the spring of 2022, when you saw the, 4 75 basis point hikes in a row, you were looking at a, probably a 10 to 20 sigma event there in terms of expectations. We went into 2022 expecting, I think the market was expecting 3 25 basis point hikes, and we ended up getting 300+ basis points. So the magnitude of change relative to expectations was insane in the end of 2021 and 2022. Now we're haggling over whether we're going to have 25 basis points and another 25, or if they're going to pause. I mean, it's just like the magnitude of impact here relative to expectations are just so minute compared to what we had last year that it really doesn't matter. I mean, clearly for 48 hours after the FOMC event on Wednesday, the markets will care. You'll have a lot of algo-driven responses. You'll be keying in on every word from Powell in the presser. Certainly 2 weeks later when the minutes come out, you'll certainly have a 36 to 40 hour reaction to that. But in the long scheme of things, it's over at this point. The market already knows that the Fed is going to pause soon. There's a reason why 2-year yields are, 100+ basis points below Fed funds rate, right? The market is telling you what's going to happen, and what actually happens on Wednesday is fairly irrelevant at this point.
Right, Jeff, you talk about the hikes being over, but do you have a view on this regional banking crisis being over? I think we heard Jamie Dimon yesterday say that this is the end with First Republic, but we're seeing a lot of these regional bank stocks falling today. Is it over, the banking crisis, or do you have any viewpoint on that?
Yeah, I mean, it's absolutely not over. And Jamie Dimon is doing the same thing that every bank executive has done for 100 years, which is that bank equity is worth absolutely nothing more than what your belief in the CEO and their statements is. I mean, we've had $100 billion plus of equity market cap erased just from Silicon Valley Bank, Signatures, Silvergate, and Credit Suisse alone, not even, including First Republic here. It's not over, and it's not over for a couple of reasons. One is that bank deposits are fleeing. They're fleeing in record sizes right now because, again, money markets are paying you 4 to 5% right now, and banks are paying you under 1%. That was maybe fine 2 months ago when people thought that your assets in a bank were safe, but now that everybody is re-rating what it means to be safe, you're not going to take increased risk for decreased returns. And that's effectively what you're being asked to do if you hold any money in a bank account right now. Independent of FDIC insurance, it just doesn't make sense economically. There's no reason to hold money in a bank account right now versus a brokerage account unless you absolutely cannot open a brokerage account or you just don't even understand the difference between the two and what it means. So bank deposits are going to continue to flee. And bank deposits are the cheapest source of funding for banks. When that goes away, they have to go find more expensive sources of funding. So that is going to consistently hammer bank earnings. On top of it, you have over 600 billion of identified unrealized losses on bank balance sheets. I've seen the number as high as 2 trillion, but the most documented number was 600 billion. FDIC insurance is only 100 billion, and that's what's left after 20 billion just went out for Signature and Silicon Valley Bank. So it's not over. It makes no sense, right? Unless you're going to see a 300 basis point rally in treasuries that all of a sudden just makes the asset values go higher on these banks' balance sheets, you're going to continue to see deposits flee, and you're going to continue to see regional banks fail. Now, to Jamie Dimon's point, it doesn't a bank failure is not that uncommon, right? I mean, we are talking about it more today than other times, but banks fail all the time, especially regional banks. But again, I think the difference is 2 months ago was a real wake-up call, or really March 10th was a real wake-up call for people outside of crypto and outside of banking. Small business owners, individuals were like, they went to bed one day thinking their assets in a bank were safe, and the next day they didn't know if they were going to be able to get them out. And granted, the FDIC and the FDIC and the Treasury and the Fed worked really quickly to solve that problem, but it wasn't quick enough for the small business owners who didn't know if they were going to make payroll on Monday. And when that starts to re-rate,
I think it makes sense.
Yeah, it re-rates what you think, and it changes your mentality, and it's not going to change. It's not going to go away anytime soon.
Right, so hopefully Bitcoin can offer a way out for that. I want to kind of pull back and ask you somewhat of a either fun or outrageous question. And I'm sure you know about Balaji's outrageous $1 million per BTC bet that was closed today. We're going to play a little video here so we can listen, and I want to get your thoughts on it.
Okay, here's Powell, here's the pilot. He's the pilot of the economy. The dollars are flowing around the cockpit. He thinks he knows what he's doing. And you and I, we're just passengers in the plane, okay? I don't have control over this economy. You probably don't. And the dollars are flying around the air. And so, if Powell is crashing the plane, and I believe he is, then the question is, how much time do we have? And I don't know. But I do know that when you're trading, yes, too early is the same as being wrong, okay? But if you are preparing, then hell is truth seen too late. And so I've sounded alarm. I've done my duty in my view as a citizen. That's why I burned $1 million to tell you they're printing trillions.
So Jeff, any just quick thoughts, reactions, and we can move on?
Yeah, I mean, look, I like to be more pragmatic than your typical digital asset loudmouthed, exaggerator, and not specific to Balaji, but obviously there's been a lot of people who have, quote unquote, become famous for just being outrageous in this space. Clearly, his $1 million bet was outrageous, and I don't want to celebrate that. But that being said, there is some truth to what he's saying, which is that forget the price right now of Bitcoin. If you really think about what Bitcoin is, it is insurance, right? It is insurance against a calamity where you do wake up one day and either your dollars are worthless or your money in your bank is trapped or you just don't have assets, right? Again, the last 6 weeks has been a wake-up call in terms of what is the value of a bearer asset. It doesn't have to be Bitcoin. It could be other bearer assets, but certainly Bitcoin is the lead in terms of just being that safe bearer asset narrative. If you think of Bitcoin as insurance against a future calamity and you have some probability that could happen, it doesn't even have to be a very high probability, Bitcoin is a very cheap asset to own as a long-tailed asset. You look at how many trillions of dollars of debt are out there. You look at how much hundreds of billions of bank equity. All of that could one day be really problematic. And if that's the case, you're going to want to own something like Bitcoin to protect against it. So as a very cheap insurance, and I'll just leave it as this. If you think about how options are priced, if you ever looked at the Black-Scholes model, there's 5 components of Black-Scholes, but the 3 that matter for Bitcoin is its interest rates, which are still historically low, its volatility, Bitcoin is very high volatility, and it is time. And Bitcoin is basically a perpetual call option with no maturity. And as a result, it should be priced probably multiples higher than where it is, just as a long tail call option on a future society where your money and your banks are not what you thought they were.
Right. Jeff, that was great. We really appreciate having you, but we're all out of time, unfortunately. Thanks for joining us.
Great. Thanks for having me.
That was Jeff Dorman of Arca.